All right, well, greetings, everybody. Welcome, investors. Welcome to our special educational session before our April 26th roundtable session. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by Ken Kavula, and Ken and I will be doing the first half of the presentation. Then we'll go into a traditional roundtable, and we have Candace Baker of St. Louis and Ann Manning of Houston with us for the rest of the show. So we're going to be with you for the next couple of hours. Good evening, Ken. How are you?
I'm doing real well tonight, Mark. It's been a terribly ugly weather day up here, but a nice day to be home. We got to sleep in our own bed last night after traveling for about 9 days, so it was nice.
Good stuff. And yes, those of you that have asked, that is probably from opening day at Busch Stadium in St. Louis, and those are Clydesdales and wonderful workhorses. That's the subject of our first 45 minutes or so together here this evening. And we've been talking a little bit for the last few weeks about the medium-sized companies in our portfolios and how they are something of almost a flyover type thing. We spend an awful lot of time seeking, our best small companies, and of course the large companies that dominate portfolios. And the ones in the middle actually have some fascinating characteristics and contributions to investing. So that's what we're going to touch on here for the first few minutes here tonight. So I'm going to go ahead and kick us off, Ken, with our standard disclaimer. This applies to the entire program tonight. No investment recommendation is intended. This is about education, and specifically a demonstration of philosophies, methods, and techniques that are 8 decades in the making with the modern investment club movement. So consider everything here to be for illustration and demonstration. They are our opinions about this stuff. We think there are tremendous lessons that have been learned and success achieved by many of us as individual investors and clubs in the modern investment club movement. So please do your own homework before making any decision. And if we own something we're talking about, we'll try to remember to point that out. If you'd like to be added to the roundtable reminder, we do a monthly program. That's the second half of tonight's show. Send an email to nkavula1@comcast.net. And if you'd like copies of the slides, my email address is there, markr@manifestinvesting.com. Any further comments, Ken?
No, Natalie is eager. She's been getting a lot of requests ever since we started advertising this event in St. Louis. So we hope we've added a fair number of St. Louis folks to our reminder list. And that reminder goes out once a month. That's the only thing we do with those names. And we just let you know that the roundtable is coming up, the time and the date, and give you a chance to register for it.
Okay, well, let's go ahead and proceed with a little bit of history. I actually think that, and Candace, I want to say thanks to you and Fred and Ray and the whole team down there in St. Louis. We've been doing this for a while, and I consider St. Louis to kind of be the birthplace or the foundation of what ultimately became a series of classes that we talk about success or successful investing. And this one goes back to April 2009. This was a full day program, and we just had a blast. I just remember sitting in the parking lot after the session and talking to people after the session, and that's kind of where this all kind of started. And we've been back a number of times. I put together just a few slides just to make the point that we've been doing this in St. Louis for a while. We came back a couple years later. Both Ken and I were here for this one. Focusing in on the beginning aspects and the fundamentals, getting started, what's it all about. Spent a little bit of time talking about Denzel Washington and explained it to me like I'm a 5th grader. And that was a fun session. Ken, you probably remember that one.
I do, Mark. I missed the first one. I had a previous engagement, but I've always enjoyed the St. Louis audiences, and I look forward to this evening as well.
And then part 3 was just a few years later, again, talking about this notion of super investors. In fact, later on in the program, we're going to talk about one of the super investment clubs from St. Louis. They have the mutual friends down there, but they also have the broad assets. We're going to talk about them for a minute as being super investors. And again, just extracting the lessons that we can learn from watching people who are successful at this. And that's what this entire session was basically built around. So that was the third one. Then we were going to do the fourth one last year and then this year. And again, COVID got in the way. So it really was kind of the inspiration behind these successful investing conferences. We've done 4 of them now, about 6 months apart. And the one that we did back in May 2020, I just wanted to point out, and I'm pandering to the St. Louis audience here now, that one of my panel selections was AB InBev. It's up 24.6. Now, I did do some field research on that one and found it to be a good product, and it's worked out pretty well so far, up 24.6% annualized since then. But yeah, we've had a number of successful investing conferences, including the panel sessions, which are very popular, and had a pretty good time with that. Like I said, we've done it 4 times. There have been 4 conferences. That is why you might want to take a look at the type of selections we made. The selections we made back in May 2020 just knocked it out of the park. And it was a great time because you may recall that was just after the start of the COVID-centered recession. So I know that, Ken, you've enjoyed them also, enjoyed the sessions.
Well, putting them together was something. It's a whole different idea about putting these kind of conferences together rather than putting something face to face together. And in a way, it's very gratifying to do not nearly as much work as a face-to-face event, and yet to pull audiences 2 and 3 times the size of the convention audiences. That rate of return, beating the market by over 5 points, is certainly something to be admired. And not all of our picks were right up there with that kind of return, but the average was. And I guess that's what you do when you're trying to put a portfolio together, isn't it?
The big portfolio, yeah. Some of ours from the last session are still definitely a work in progress. So we continue to be hopeful. Then I also want to go back to a national convention in St. Louis. Back, I don't remember the exact year of this one. Was it 2010?
Oh, it's dated 2010 on the picture, Mark.
Okay, and notice the picture. It's from the session that Ken and I like to do. 2 guys talk stock, and David Carson from the St. Louis Post-Dispatch takes the picture, and it says right there, Mark Robertson, not pictured. Not that I bring this up very often, but I'm a little bitter. It's
Don't let him fool you, folks. He brings it up every time he gets a chance. So.
But for those of you that aren't aware, the Pulitzer Prize, it is named after Joseph Pulitzer, who was involved in the publishing business in St. Louis. And I just love that quote. Again, it comes down to the stock selection guide methodology and philosophy of making it so people can see it. Some of us are very visual. Some people don't like numbers so much as pictures, and it all kind of comes together. And well, I'll let you tell the story, Ken. I mean, it was so much fun with this photographer in the room. He's sitting at the back as the class is going by, and I'll let Ken describe what he presented, talked with us afterwards about.
Well, we never quite know where a 2 guys session is going to end up. It goes all over the place, and we listen carefully to the things our audience asks us to talk about, and we're prepared to move in lots of different directions. But at one point during this particular session, we were looking at visual analysis of a number of different companies that people were shouting out tickers from in the audience. And some of the visual analysis were really pretty, up straight and parallel, as the folks in mid-Michigan like to say. And we were getting oohs and ahs and applause from the audience. And then somebody would call out a clunker with no earnings line, or with an earnings line that looked like a roller coaster from Cedar Point. And they'd be guffaws, and there'd be all kinds of people kind of mock booing and telling us that was not the kind of stock we're looking for. And we really threw the reporter for kind of a loop. And when the whole session finished and he came up to talk to the two of us, he wanted to know what kind of cult this was, that we could take the emotions of the audience and take them from applause to booing and everything in between just by showing pictures on the screen. So you know what we're talking about. We were doing nothing more than looking at the visual analysis of the SSG and appreciating a really great growth company and the way that it looked on the graph. That's all.
Yeah, it was good fun, and I actually have forgiven David Carson a long time ago. He's actually one of the most respected photographers in the nation for newspapers and stuff. So pretty cool. All right. Well, Ken, I'll let you take us away here with just a reminder of, what these 8 decades have been about.
Well, I've seen these principles written and talked about in so many different ways, but they all come down to just a very few good, solid, basic ideas. Invest regularly, diversify, and diversify prudently, which to us means not only by sector and industry, but also by size of company. Stay invested, have a lot of patience. The better investing methodology demands that you be patient and, more importantly, that you be disciplined. It calls for you to sell occasionally, and that's part of the discipline, just like buying is, but we're not selling willy-nilly. We're selling after we have good reasons to sell a company. And most of all, it focuses on the best companies. We can find instances of George Nicholson, and that's him up in the upper right-hand corner there. We can find instances many times of Mr. Nicholson writing, buy the best. Always look at an industry with an eye towards buying the best, or at least the second best growth company in that particular industry. The other two people below Mr. Nicholson are Mr. Tom O'Hara, who was the longtime CEO of Better Investing, and beneath that is Ken Janke, who was the longtime executive director of the association. So together, those three men are the shoulders on which we stand today, trying to move forward with those particular principles that come to us, for they're 70 years old. We're celebrating our 70th anniversary at the Dallas convention. We might be celebrating it a year or two late because of the pandemic, but we're celebrating 70 years of patience and discipline, and most importantly, of well-crafted, high-performing portfolios.
Absolutely. So let's go ahead and keep rolling. All right, let's go ahead and tackle a little bit of a misunderstanding that we often encounter when we're talking to investors. And I know this is one of Ken's favorite areas to try to reinforce and demystify a little bit. And a lot of times we'll hear about people screening for 15% growth. And what I wanted to do is just kind of put in context. What I did is I took the companies that are in the Value Line Investment Survey, the book, and just basically characterized, well, where do they actually fall when you talk about their sales growth forecast. And I think you can see pretty easily that's kind of a flattened bell curve on one side. Somewhere around the middle of that chart is in that 8%-ish range. So right around 8%. So to really find a company, especially in those larger, more established companies, it's pretty tough to find those 15% growers. And I know this is one of your pet peeves, Ken, so go ahead and mount the soapbox.
Well, folks, Mr. Nicholson never suggested that each company should grow 15%. He said you wanted 15% growth in your entire portfolio, and that was just a shorthand way of him telling us he thought we could beat the market by 5 points. Over history, Mr. Nicholson knew that the market had returned 10 points, give or take a point, for lots and lots of years. That number, by the way, is still true today. The market on average does return somewhere around 10% a year on average, and that depends a great deal on how you're going to measure the market. There's a lot of different ways to measure it, but if the market's returning on average 10, Nicholson said we could beat it by 5, hence the 15% was grown. was born. He never started out with the idea that you could double your money in 5 years. That, in fact, was a marketing campaign out of the 70s that Better Investing used to draw attention to its methods. But it wasn't the prime reason that 15 was chosen. Nicholson said, I think we can beat by 5, and if you try to beat by more than 10, you're being greedy, and it's almost impossible to do. So he kind of defined a range that he'd like to see investment clubs operate in, and that would be somewhere 5 to 10 points above the market performance, whatever the market was doing in that particular year.
So let's carry the discussion just a little bit further. And this is where you get into again, making the distinction between that 15% number, which did refer to the total return on the portfolio, and breaking it down into the components now. And this is actually a question from an investment club that we answered in one of those successful investing conferences, where we fielded a bunch of questions from investment clubs. And they basically were suggesting that we don't seem to pay a whole lot of attention to company size, and we do. And in fact, the part of the message of tonight's session is that the recommendation is for us to buy and maintain a portfolio of medium-sized companies that accounts for almost half the portfolio. And, we define a medium-sized company as a company growing between 7 and 12% at the top line growth. And this is just to illustrate how easily it is to become confused by it. The bar chart on the left is from Forbes, where they basically ask the question, how do you measure a company's size? And you can see there's all kinds of different answers. Wall Street uses market value or market cap most commonly. Better Investing does center around, at least part of the time, on sales. And you can just see there's a whole bunch of answers, and our answer is none of the above. It's the sales growth forecast that makes the most sense. And that's coming straight out of that book on the right. The NEIC Investor's Manual was largely written by George Nicholson, edited by Tom O'Hara. There were some contributions from Ralph Seeger in the text, but in that book, it makes the point. The 15% is about the total portfolio, and that was to be achieved with an overall sales growth forecast of 10 to 12%. And so again, you stack up the companies in your portfolio to reach that threshold. Some of the companies in your portfolio are going to be larger companies growing at like 5 or 6%. So for all of those, you have to have smaller companies to offset it. But again, the nuts and bolts of the portfolio is very often going to be those one right down the middle, those medium-sized companies growing between 7 and 12% that really carry a lot of the load. Your thoughts, Ken?
I agree, 150%, Mark, if I can use a number that doesn't make any sense itself. The portfolio mixture of these small, medium, and large was something that I discovered when I first discovered Better Investing. And I was taken at that point by the amount of time that wasn't spent on looking at small and medium-sized companies. The Better Investing that I first became acquainted with was spending an awful lot of time focusing on large dividend-paying companies. And when you read the materials that Better Investing had available, you found that that was only a piece of the pie. That the small companies contributed something very, very unique to the portfolio, and that was sales growth, which you needed to make these lofty goals of beating the market by 5 points. And then, like you call them, the flyover companies, the medium-sized workhorses of the portfolio, and those are the ones that you need to have in abundance to be able to come even close to that beat the market number. So all in all, I think that the diversification, we've done a nice job in the last 30, 35 years in Better Investing about bringing the small caps and the mid caps on board now. And here I am calling them capitalized. It's actually small companies and medium-sized companies as defined by sales growth.
Mm-hmm. And for more on that subject, that link at the bottom is a public link. And if you do have trouble getting to it, send me a note and we'll fix that right away. So again, here, just to reiterate the stuff we've been talking about, Again, these workhorses, the ones right down the middle, we spend a lot of time talking about, especially a lot of those up, straight, and parallel companies are blue chip companies, stalwarts that are large and mature, and with sales growth forecasts is in that 3 to 7% range. By the way, 3% is the point at which Mr. Nicholson said he began to lose interest in a company, and perhaps the sales growth is just not robust enough. So that's where that 3 comes from, and then 7 being the upper limit of those larger companies. And the smaller ones are 12% and above. Ken and I spend a lot of time talking about those, and we do find that we focus on both ends of that spectrum. Yet down the middle, 50% of the portfolio really should be, as it says in that last statement. And we really don't spend a commensurate amount of time talking about those companies.
It's also surprising, Mark, what kind of companies end up on that list, especially when you're using the definition of sales growth to set this small, medium, and large. I sometimes wish instead of calling it those 3 things, we just talked about slower growing, faster growing, and average growing, or just growing companies, because that's really what we're talking about. Your intuition fails you sometimes until you look very closely at the sales growth forecasts and tell yourself, I don't care what I think about this company, it's acting just like the other medium-sized companies that I have in my portfolio.
Yeah, the cap thing is a problem. I mean, when we talk about this every year with the small caps are not necessarily small companies. There's a lot of companies that are classified as small cap, and they're small in terms of the value of the company because they're damaged goods. And they're not just simply faster growing companies that are on their way up. And again, that distinction is an important one, and it's one that Wall Street gets wrong all the time. And it's part of some of the problems with Wall Street. This graph actually captures it a little bit. We talked about this one. This has been kind of a popular slide. So Ken, would you like to walk us through this one? Just this is kind of a stunner.
We basically just, and again, you can't get statistics as often as you'd like based on the kind of definition we use for growth. So we're using capitalization as a proxy for growth. And even when you use capitalization, even though we know that there are companies in these capitalization definitions that probably don't have the growth to match the name that we're talking about, we notice that the mid caps, the medium-sized companies, tend to outdo the largest of the group, and that would be the S&P 500. The S&P 500, the blue line, is essentially made up of large, more slowly growing companies, and that's what you would expect, and you would expect the growth, the appreciation, to match the growth, and it's slower. In a lot of cases, that red line, that's the small companies, will, kind of trade places with the orange line. They both grow fairly robustly when you're talking about capitalization. But what's interesting to me is the performance at the top of the chart at the bottom there, where you look at the value line arithmetic average, which is made up of a selection of small, medium, and large companies. It's made up of a lot of the companies that Mark has circled there, but you put them all together and you go over to the right-hand side and you notice that it seems to perform better than almost anything else, better than the total market, that's the Wilshire 5000, and better than any of the segments of the market, whether it be small, medium, or large. Again, the mixture of sizes of companies tends to keep your portfolio growing at its maximum ability, and that's what you should be looking for when you put a portfolio together. Recommendations, again, half of your companies in that mid-cap range, and let's drop the cap and just talk about medium-sized range, and that's growth of 7 to 12%.
Yeah, and in fact, this afternoon we were talking about this a little bit, and I'm reminded of a specific St. Louis moment. You're going to remember this one, Ken. We're sitting in the hospitality room with Sam Stovall from Standard & Poor's, and we were talking about how we could actually point to a number of investment clubs that had basically sidestepped recession and tough times. And you can actually see some evidence of that here. We talked this afternoon a little bit about, notice that the blue line between this point here and this point here, that's what is known as the lost decade in the S&P 500. It basically went down in what you're looking at here. And during that same time frame, we actually saw decent gains in the medium and smaller sized companies over that same time frame. And then over the last 10 years, from 2010 till recently, the S&P 500 has been red hot. Our concern is if that gets overheated too much, we could have another one of these flat spots, with the S&P 500. And that's all the more reason to have that appropriate mix of medium and small size companies. So do you remember wrestling with this one over adult beverages with Sam Stovall?
Oh, a number of times, yeah, Mark. One of our friends in the audience, Matt Spielman from Houston, makes a humorous point. He says that if you have a 50-year-old small cap company, it's probably not a small company by our definition. So, when you have lots of history attached to a small cap, it's probably not growing at the kind of rates that we would suggest a small company needs to grow at.
Well, that's a natural segue. So Matt gets a star because, yeah, you get a great small company. The point of the story is your work is never done here. Because a good small company is going to become a medium-sized and a large company if it's successful enough. So we'll talk about that a little bit. All right, here's a quick look at finding current medium-sized companies by that 7 to 12% threshold that we're talking about. I'm using Manifest Investing here, the stock screener, and what I'm doing is basically looking for companies that fit that growth rate range of 7 to 12%. And then all I did was throw 80 and above is an excellent company. 80 for financial strength would be basically an A or better in financial strength, if you want to think of it that way. And the 80 for EPS stability basically says you're dealing with a company that has fairly consistent, reliable earnings. And that's a pretty good chart to go shopping. What jumps out at you, sir?
Well, and again, as you read down that list, I think some of you would be surprised to see a Visa, for example, on that list. My immediate thought about Visa is that it's a very, very large company, but because of the kind of growth that it exhibits, really it's a medium sized company. It's a good, solid, average grower, and that puts it in that 7 to 12% range. It's not growing slowly enough to be considered a large company. There's another couple ones on that list that might surprise you. Go about halfway down and you'll find Microsoft on that list. Now, I know that they're getting beat up real badly today after the market closed because of their earnings report, but earnings reports happen very frequently, and strange things happen around earnings reports. And a lot of times, whatever happens around earnings, you look at it a month later and you can't even tell what was going on. So I have faith in some of these companies that the growth is going to continue. And I have faith that if we stick to our discipline, we're going to be able to put portfolios together that are going to take advantage of that kind of growth.
A lot of these companies are in community portfolios for sure. And again, the other point to be made is Visa, it might seem like a pretty large company, but that is an awfully big swimming pool, an awfully big pond that they play in. So that's another way to think about it. I just ran one more really quick one with 90s instead of 80s, just to show you the type of companies that make this type of list. There's a number of long-term community favorites. MasterCard makes this one. Fastenal, Middleby, Apple even makes this one. So you can find these are very strong up, straight, and parallel type characteristics for a group of companies that fit the medium-sized definition by growth. So good, clean fun to go shopping, especially those ones up at
Even
the top.
even in the middle of that list, Nike, Mark, that's a kind of a surprise to me. I would not have guessed that Nike's growth is as robust as it really is.
Mm-hmm. That's a good study for an opportunity to own it at the right price. Definitely.
Absolutely.
All right, so we'll spend the rest of our time talking about some specific examples, and this is where Matt Spielman's nudge comes in. I was a member of the Mutual Club of Detroit for several years, and they had actually bought O'Reilly Automotive back in the 1970s. And a good Missouri company, no stranger to most of us here. And you can see in those early days, I mean, I would have joined that club back in this time frame, so that they already had probably almost a couple decades of experience with O'Reilly at that point. Back in that time frame, it was growing pretty rapidly. It satisfied the small company definition of 20%, approximately 20% for a growth rate, and it matured over time to where it's basically firmly ensconced in the medium range during this point. I'm kind of intrigued by the little bit of an uptick here, also, Ken. But what you're looking at is basically a very long-term SSG. Stock selection guide, because that's the sales up at the top, the price down the middle. Very rewarding for somebody who has owned it for quite a while. The Mutual Club owned it for at least 3 decades at that point in time. So you can see a little fun fact there. 2000 invested in O'Reilly back in 1994 would have been worth almost $500,000 30 years later. Annualized total return of 22%. Those are the earnings down at the bottom, and you can see they've been handsomely exponential. So that's my first memory. And again, I'm reminded of I never was in a meeting with George Nicholson. I came after him, but Nicholson came into the Mutual Club meetings and basically said, what small and medium-sized companies are we pursuing on tonight's agenda? Tom O'Hara continued that tradition, and I definitely heard that.
Just a note before you get off those 3 charts, Mark, I like the analysis about that might look like an SSG. And I just want to make the point that the first 2 graphs are displayed on logarithmic paper, which makes consistent growth look like a straight line. And the last one is displayed on traditional graph paper, which makes consistent growth display as a piece of a parabola, as we're seeing there. So if we were to put that on logarithmic paper, we'd probably see 3 straight lines, and we'd see that up, straight, and parallel concept that we'd like to.
All right, I'll fix it for the next time around, Ken. You caught me. You caught me.
We're looking now at something that I started to do when we put this concept together for this class. I wanted to kind of look at my own portfolios that I'm involved in and that are kind of out in the public there. And I wanted to see how closely I was following the concept of a large percentage devoted to mid-cap stocks. I remembered that my accounting software would allow me not only to look at the size of the company, but would allow me to look at the annualized internal rate of return. And that's the only way to really figure out how a stock is doing year over year over year. It's a little bit more complicated than just taking the end value and subtracting the beginning value and ending up with a return value. IRR is a much better measure of it. So I went to the Mid-Michigan Model Club, which has been around for about 14 or 15 years now, and I started looking at the stocks that have large annualized internal rates of return, and those that I greened out near the top of the list there end up being the stocks that are medium-sized growth, growing between 7 and 12%. Credit Acceptance doesn't fit that category, neither does Checkpoint Software, but the other 7 companies up there are showing pretty decent kind of return, and that's the kind of return you want out of a workhorse. I especially appreciate the return, and I'll admit I was flabbergasted to see the return coming from O'Reilly Automotive. And look at the date on that one, folks. That dates back to 2004. for that holding. So 2004 to the present time, that's 18, almost 18 years now. And we're looking at a 44% annualized rate of return. You don't have to go after fancy high-tech companies to get outstanding returns from pretty easily understood kinds of companies that just very quietly keep growing at 7 to 12% and keep themselves right in the place where you'd like it to be. I would do anything to have 8 or 10 of those companies in my portfolio. Right behind that Monster Beverage, that's no slouch either, and that's coming from 2008 to the present time. That's 14 years at 38% IRR. I really think anything around 8, 9, 10% IRR is doing its job in the portfolio. So there's a kind of a list of companies that have been doing their job for a relatively decent period of time. In fact, if you look at the annualized internal rate of return numbers as you go all the way down to the bottom of the list, kind of compare it to the dates, you'll find that the worst returns are coming from some of our newest holdings. And I think you might expect that to be happening, especially when you consider what's been going on for the last 2.5, 3.5 months in the current market.
Well, we need to move on.
Just be patient. Just patience. That's all it takes.
Be patient. I think you need to have Fred Tunnies actually deliver a thank you to O'Reilly next time he sees him.
Okay. Here's from the B.I. Baker Model Club, another model club that I belong to. And there's a company at the top of that list, almost 38% IRR. And I doubt if many of you even know Mastech and what it does. MTZ is the ticker. I'm going to leave that as an Easter egg. Go and check it out. Take a look at the SSG. Take a look at what it does. And I think you'll be pleasantly surprised. I know that since 2020, we've been pleasantly surprised at the return from this stock. This is a much newer club. This club's only about 8.5, 9 years old. And one of our oldest holding is doing a nice job of holding its own. And that's Dollar General down there in the 4th spot at 22% plus IRR. And we've been holding that one for, it's going on 8 years now, I guess. So you have some really good things happening. Look at the difference between Google in this portfolio and Google in the portfolio previous. When you buy a stock makes a whole heck of a lot of difference as to what the internal rate of return is going to be. The Google in the Mid-Michigan Model Club has only been held for less than a year. The Google in this club's been held for going on 8 years now. And you see we're going from negative returns to good, solid, positive returns in those two sets of numbers. One more set of numbers just to show you some names, and this comes from my own personal investment club. I found that we were holding a few more stocks than the model clubs held, but again, I could find 5 out of the top 9 or 10 stocks in the portfolio that were good, solid, medium-sized companies. And when I look at United Health Group, UNH, which is only a 2-year holding, a little bit more than 2 years at 45% internal rate of return, I could say to myself, somebody in that club did a really nice job of presenting an SSG at a very opportune moment. Kind of pair that with United Forest Products, even after the market declines since January, we're still looking at a 35% internal rate of return for just over a year. And there's a 2-year return on Apple. I'm sorry, there's a 12-year return on Apple. And that, of course, is the stock that's keeping this portfolio moving ahead, chugging right ahead. That plus, of course, our AbbVie holding, which we're really excited about AbbVie, even though we have never been able to buy a whole lot more of it. We bought it twice, and then it moved right out of the buy zone. And we are very disciplined, so we didn't go chasing it. But the little bit that we have, the 100 shares that we have, are certainly performing for us. So you can find these stocks. They're good, solid names. And there's nothing fancy going on here. It just takes a little bit of time, a little bit of diligence, and you can come up with these SSGs. And then don't force your SSGs, folks. Make sure that they're reasonable, make sure they're on the slightly conservative side, and then wait. Wait for them to demonstrate that it's time to buy the stock. Listen to what your stock selection guide is saying to you.
Yeah, and the images down at the bottom are just a reminder that this is an actual former Groundhog Group champion from a few years ago. I think it was 2010, if memory serves me correctly. And that's a before and after picture with the wolves from the center. And then after winning the contest, you could see they're on the beaches of Cancun or something.
I didn't realize that's where you were going with the graphics, Mark. Okay.
We'll hear more about them when we talk about broad assets. All right. I want to close with this slide. And again, it's a reminder about the power of these medium-sized companies, these workhorses that can be such a wonderful thing. I actually wrote this when my first grandson was born just a few years ago. I was actually at the Capital Area Chapter in Lansing, Michigan, the night before he was born, and wrote this the next day. I would invite you to go and take a look at it at Manifest Investing. But again, this notion of starting early and investing in these type of companies and how powerful it can be. The reason I brought this is because I remember Biomet so well. I mean, they're now part of Zimmer, but my mom and dad, that's the great-grandfather and great-grandmother that are mentioned here, they were actually in Springfield, Illinois for one of those investor fairs back in the heydays. And I came down to breakfast, and mom and dad were sitting with the Biomet investor relations person having breakfast. And she made the point to them that $2,000 invested in Biomet as recently as 1982, and this would have been late 1990s, was worth $1 million. And my dad sat there and he says, I had just left the railroad. I had that new job at the golf course, and I had that IRA. He's away from the railroad retirement fund and all that stuff. He had an IRA. He had $2,000 in his hand in 1982 looking for a home for it. He says, I could have done that. And that's such a powerful thing. So anytime somebody says, I want the next Microsoft or the next Apple or the next Amazon, or, you fill in the blank. My contention is you need to find the next Biomet. And it can be such a powerful thing in your investing experience. So that I'll leave you with that thought. I think that's just an awesome moment to point out what is possible. And you're never quite sure where they'll come from, as Ken was showing you with those actual club portfolios. So with that, I think we can close out with some images of our workhorses. And I love the Dalmatians. And I think many of us are very fond and familiar with the Budweiser Super Bowl commercials and the commercials over the years. So we'll just tip our hats in the direction of workhorses and cherish them.